Welcome traders, Maciej here from Taurus Trading. In this video you will learn how to trade candlestick formations in context of bigger market picture, so stay tuned. The best trades are always in alignment with the bigger picture. It's much easier to look only at the candlestick patterns or indicators. The problem is those tools alone do not provide a reliable outlook of a market structure. By bigger picture, I simply mean checking what is happening on a price chart as if you were to look at it at a high altitude. You can picture it as looking at the ground when you're on a plane at 10,000 feet in the air. Bullish engulfing pattern should be only traded if the chart that you are looking at is in clear uptrend. You can also use this type of approach in sideways market, but make sure to look for engulfing pattern at the very bottom of the range. Basically, you want to find a large bullish bar that has its high and low price exceeding by significant amount the high and low price of previous bearish bar. To add higher probability to your trade, watch for bullish engulfing in well-defined area of support or other magnet like moving average. The opposite of bullish engulfing is a bearish engulfing pattern, so this time we are looking to take a trade only if market is in clear downtrend. Alternatively, you can trade this setup at the top of the range in a sideways market. To meet the criteria of engulfing formation, we need relatively upper leg. In example, pullback in a downtrend. Once you see a large bearish bar completely engulfing previous bullish bar, you should take a short position. For this type of setup to have a greater chance of success, it is much better to trade it in area of resistance or if engulfing bar is touching the moving average. A bullish hammer candlestick formation is the sign from the market that the lower price was clearly rejected and the buyers were able to gain control. For this setup to be even more valid, it is necessary to have a bullish bar closing on its high and penetrating previous zone of support or some long-term moving average. The opposite is true for bearish hammer. Ideally, you want to see some type of pullback in a downtrend and then large bearish bar closing on its low with so-called wick at least 2 or 3 times the size of the bar's body. The best area to fish for this type of setup is previous resistance zone or touch of the moving average. Hanging man candlestick formation should be only traded if the chart that you're watching is in a clear downtrend. After few not too strong bullish bars, you can wait for pullback to lose its momentum. If hanging man appears in well-defined zone of resistance or at the moving average, this setup has greater chance of being profitable trade. Morning star and morning doji star are both candlestick formations that requires market to be in clear uptrend or alternatively at the bottom of the range if you are dealing with sideways price action. The main idea of this setup is to trade in the direction of the main bullish trend right after pullback phase has finished. The last bearish bar in counter trend should be followed by either doji or small bullish bar. Third bar, which completes the setup, must have relatively large bullish body and ideally closes on its high. Probability of the trade being a successful one increases in the area of support and at the moving average. An evening star as well as evening doji star should be only traded in falling market or at the top of the trading range. You might want to wait for pullback phase to lose momentum and last bullish bar needs to be followed by small bearish bar or doji. This way market tells us that buyers have lost control and we can now enter in the direction of the main downtrend. Best place to look for this setup is previous resistance zone. Tweezer's bottom candlestick formation is basically a mixture of few bullish formations creating one big pattern. It is always present in an uptrend, usually in an area of previous resistance, now becoming support. Market should test repeatedly the same zone, and it's evident that sellers are not able to drive the price lower. Very often you can see a morning star being formed and then followed by bullish hammer couple bars after. For this type of setup to have a greater probability of success, watch support zones like moving average or trading range bottom. Tweezer stop, on the other hand, should be only considered if the chart that you are watching is in a clear downtrend or at the top of the range in sideways market. Tweezer stop can be composed of elements like an evening star and hanging man. You should be able to spot market testing an area of resistance after small pullback. Once it's evident that buyers have lost their momentum, you can enter in the direction of main downtrend, ideally in the area where bulls have placed their protective stops. This should add more fuel to the downward move. If you are interested in other types of candlestick formations, please watch my video dedicated strictly to these theoretical aspects of this subject. Also, consider subscribing to my channel. This way you won't miss my new exciting videos which are already in the works. Make sure to visit my website and grab free ebook about financial markets. Link is in the description. I hope to see you next time.